Hello, everyone. Hello, 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 everybody who's out there. This is live. We are live today, and we are talking to our first live broadcast on YouTube. This is Jason Corona with Corona Accounting Solutions. Today on Tax Talk, we are talking about balance sheets. What is a balance sheet? Why is it important? And what consists of the balance sheet? So with balance sheets, you have quite a few things that actually go on a balance sheet. Balance sheet is basically a report that you print out with your accounting software that shows all of your assets, your liabilities, and then your owner's equity for the business. Um, why is it important? Because it's important to know when you have a business, if you're trying to get some kind of funding or lending from a bank or a credit union, that they need to see how much you have in assets, whether it be physical assets, fixed assets, cash, liquid assets, inventory, and then also what kind of liabilities do you have? What kind of loans do you already have? What kind of credit cards do you have? What kind of payables, etc. And then also, what have you invested in? That's always also a really good question that lenders want to know. Um, so just to kind of go through fairly quickly, and I'll have more live topics on balance sheets and the individual type of items that are on the balance sheet. I'll have those coming out here fairly soon. But some of the things that are on a balance sheet are your cash and bank accounts. Okay, accounts receivable if you're on an accrual basis. So the people that owe you money that you've invoiced out, that's known as accounts receivable. Loans to shareholders or partners, so that the business has loaned a partner money or a shareholder money. Loans to employees. If an employee decides to borrow money and the company approves it, they can actually put that on the balance sheet, and that is a liquid asset. Then you have fixed assets. What are fixed assets? Fixed assets are physical things that the business owns. Okay, it could be like the desks that you have, the office that you're in, the printers, computers, chairs, office chairs that you may have. It could be vehicles, it could be construction equipment, tractors, backhoes, trailers. It could be a commercial building. You can own a commercial building. There's so many things that fall into the fixed assets category. So one thing that when I was first cutting my teeth in accounting and CPA and public accounting world, I had to learn about fixed assets or more than just um, tangible things. There's also intangible things, software, goodwill, trademarks and patents, things that you cannot physically touch but are liquid assets for the company. But then I also had to realize that depending on the industry, such as like a farm, some of your physical assets and fixed assets are not just like equipment and office furniture and stuff like that, but also livestock. It's really weird to think that livestock has a specific number of has like a shelf life, has a depreciation schedule for livestock, depending on what kind of livestock it is. It does have its own depreciation schedule. Um, on the other side, so that's mainly the assets. So that's the top half of the balance sheet. And then you have on the bottom half, you have your liabilities, such as accounts payable. So when you have bills that come in and you want to pay them off, until you pay them off, the bills come in and they sit on accounts payable until you actually create the check to pay them off. Credit cards payable, so how much you owe in credit cards, the statements. You have a running balance with your credit card, that's going to be a credit card payable. Payroll liabilities, so you create a payroll system, whether it be in QuickBooks or Quicken or Peachtree or Yardi. You have a payroll system in there, and then until you actually cut the payroll check, the payroll actually goes into payroll liabilities. Another thing that sits in there, depending on how your schedule is for payroll and how your payroll is set up, is tax payments. So federal and state tax payments. Some employers are required to do them on a monthly basis. Some are not required to do them unless it's quarterly. And some people just decide to go ahead and pay them as they go. So if you have a payroll system that goes and you pay your crew every single week, after you finish paying that off, the tax payments from what you collected from their checks and then what you have as an employer portion for the payroll, that goes on the payroll liabilities until you cut the check and make the payment to the IRS or to the State Department of Revenue, whichever state you're in. You have short-term loans payable. So what are short-term loans? Loans that you pay off within 1 year. That's what short-term is. Short-term is anything that you have, whether it be a receivable, a payable, anything that's done and complete within 1 year. Long-term loans payable. If you have a loan, a business loan, a mortgage on a commercial building, things that take longer than 1 year to pay off, that's a long-term loan payable. Loans from the shareholders. So sometimes, or partners, the partners or the shareholders, they loan money to the business at a certain APR. Sometimes it's like 1% because they really don't care about the APR. They're just trying to get some money into the business for cash fluidity and funding to make sure that it has operations, but it's not necessarily trying to increase its investment in equity. So it could actually loan the money to the business, and the business has to report it as a liability because it owes that money back to the shareholder or the partner, okay, or the owner. Additional paid-in capital, that is another category where a partner or a shareholder owner, they're putting money into the company and not expecting a return of investment just yet. It's going to stay there. It's not a loan, so they're just adding to it. Draws and distributions is when you take money from that additional paid-in capital or equity account and pull it back out as a return of investment. Are draws and distributions taxable? They can be, depending on what your equity and your basis is. And we'll have an entire subject on basis. Basis is a huge one. Basis is basically your investment in the company. So we always want to keep, as an accountant, I always tell my clients, you have to keep an eye on your basis, and I will help keep an eye on it for you. If I notice that it's coming out and looking at your balance sheet, if you wind up having a negative capital account, that means you have negative basis. That becomes automatically taxable at capital gains rates. Now, the capital gains rates could be as low as 0%, or it could be as high as like 31. So it really depends on what tax bracket you're sitting in, and then also how much in the negative are you sitting, your basis. So you always want to keep that equity and that basis in a positive number, so or above zero at least, so that you're not triggering capital gains. If you have $40,000 in basis or investment into the company and you decide to pull $40,000 back out, then your basis is down to zero. Okay. And is that taxable? No, it's a return of investment. So that's a term that you may have heard before. It's called ROI, return of investment. Okay. The ROI, what's my ROI? ROI is your return of investment. You have that money that you've taken out. That's part of your return of investment. Okay. Retained earnings, that's your year over year net profit and loss that you pay tax on. It adds or subtracts from your basis. And your equity account. So that's something that as an accountant and a business owner, as an accountant, I look at and keep an eye on for you, but then you as a business owner want to keep track of that as well and just kind of be aware of it. Because if you have, let's say you have $40,000, like we go back to example number one, you have $40,000 in basis, you pull out $40,000, your basis now is zero. And then for the current year, you have a loss of $10,000. That $10,000 becomes suspended because you don't have the basis to take that loss. So that is still there, but it rolls forward on your personal return, and you can't use that loss because you don't have any basis. If you had 40,000, you pulled out 30, which means you had 10,000, and then you had the $10,000, then you can take that $10,000 loss in that current year, and then your basis will be down to zero, just to keep it from triggering capital gains. But a loss cannot trigger capital gains. A loss can only go to bring your account to zero at most, and then everything else is rolled forward to the next year. Okay, so when you have a sole proprietorship, single member LLC, okay, if you're not already taxed as an S corp and you're just a sole prop, and you have a Schedule C on your personal return, okay, the balance sheet for tax purposes is irrelevant. Why do I say that? It's irrelevant only because of the fact that on the tax return, on the Schedule C, they don't actually ask for your balance sheet. Okay, they only ask for your profit and loss. Now, if you have a partnership, excuse me, if you have a partnership and you have an S corp, sorry, then depending on the amount of money you have in there, you may actually have to file the balance sheet with your partnership or your S corp. But if not, let's see if I can get these. Okay, there it is. So if the partnership or S corp has assets of at least $1 million or gross receipts of at least $250,000, then you are required to attach a balance sheet to your partnership or S corp return. Okay, C corp is same thing. Okay, now if you have a single member sole proprietorship, sole prop, you'll hear that we in our industry we call it sole prop all the time. So if I say that, that's what it means. It means sole proprietorship. So if you have a sole prop and you have, on there, the balance sheet's not going to be required, but it's an important tool for you to keep track of and for you to keep an eye on, so that when you're looking at everything that's going on and you want to go to a bank, you want to make sure that balance sheet looks nice. It looks pretty. Now, the assets, which are everything we had, the bank accounts, shareholder loans, loans to employees, fixed assets, accounts receivable, all that, those have to equal the liabilities and equity together. That's why they balance, positives and negatives. Okay. One of my former students, she used to say pluses and minuses, but it's really, in the accounting world, it's debits and credits. Okay. And they have to balance each other out. One of the things that I see on a regular basis when I have a new client and they says, well, something's going on in my tax return, I don't know what it is. And I look at their balance. That's the first thing I do, is I look at their balance sheet. Does their balance sheet balance? And there are times where their balance sheet is incomplete or it's non-existent. It's not on the return, but they should have it on there. The tax softwares that are on, like TurboTax, TaxAct, you can actually bypass the balance sheet. Even though you're supposed to have them filed, you can actually override that. So that can be a problem. And I try to, even if you're not required to file it, I try to file it anyway, because it does help with keeping track of basis. And then also from year to year to year, when you look at a lending situation, you go into a bank, you want to borrow some money from the business, and they say, okay, let me see your last few years of tax returns. They want to see your profit and loss for the last couple of years. They want to see your balance sheet for the last couple of years. Now, if you show them the balance sheet on your QuickBooks reports, okay, and then you show them the tax return and it's not there on the tax returns, they'll be like, well, how do we know this is right? You don't. Okay, so from my vantage point, thinking ahead, saying, okay, eventually you're going to get bigger and you're going to expand, you're going to want to expand. So part of my job as your accountant is to try to help you get to that point. If you're stuck on point A and you need to get to point B, I'm here to help you formulate a plan to get from one spot to the next. Okay, but thinking ahead, let's say if you get to point B and you're like, okay, I've expanded more, but I need more money for operations. So I invested money into getting more equipment. I invested money into getting a bigger building, etc. I need more to actually operate. So then you go to the bank. If the bank looks at their tax returns and then looks at the balance sheet on your QuickBooks reports and see that they match, they're like, okay, then this person has all of their ducks in a row, has everything in line, everything matches, everything ties out. Okay, so then everything is actually really, really good, and you become less of a risk for the bank. So I don't have anybody on here just yet, but I am hoping that in the future there's going to be um, more people joining us here, because what I'd like to do is set up um, the tax talk, the chat room, to where people can come on and ask questions. I want you to ask me as many questions as you can. I will try to address each one of them when I go live. If I, depending on the question though, it can be a little bit more complicated than just, oh yeah, you just do this or do that. So I might actually take your question and create a new live video specifically to answer your question and go into detail, because sometimes the topics can be a little lengthy. So I really hope that everyone's having a great day. We're here now at 17 minutes. I'm gonna hang out for another 2 minutes or 3 minutes, excuse me, to go just to kind of see if anyone jumps on and if you have any questions. But we are here and we are ready to help you. This is supposed to be a pretty good tax season coming up. And so we're all very excited about trying to get everybody as much help as they need. So balance sheets are a very important tool for a business owner. It helps you as a business owner to make decisions and to make sure that the health of your business is actually doing well, or if it's not doing well, you can see why. But it's more than just the profit and loss. The profit and loss just happens to be a small component of it. It's the overall of the company that is helping you. I'm trying to look at different names. I've talked with my wife about it, about regarding the segment we call Tax Talk. But what I'm also looking at doing is adding in, because as an accountant, I drink a lot of coffee. It happens. Now, we thought about, like the coffee tax chat, something like that. If you have a quirky idea of what to call it, our new segments, please, by all means, we're open to suggestion. We are all just trying to do this live and try to get more help out as much as we can. So we appreciate the feedback. We appreciate everything that everybody is means to our firm, as well as we hope that we are an asset if we're talking about balance sheets. So we hope that we're an asset to you as a business owner or as the individual taxpayer. So we're coming up just on about 20 minutes. I wanted to at least go on for 20 minutes today, and we have great weather today. It's actually sunny outside. We're looking at it, and I'm like, wow, what's that bright thing out in the sky? We've had a lot of, up here in Oregon, we've had a lot of rain. So having the sun out for the day, it's actually pretty nice. So we're just about out of time today. So balance sheets are a good thing to keep track of and to make sure that they balance and make sure that they're formulated correctly. If you have any questions regarding that, 503-997-6672, or info@coronapdx.com. Info@coronapdx, CORONAPDX.com. Send us an email. We'd love to talk to you. We'll love to chat, and we will see you next time. Have a great day, everybody. Take care.